The Logic of Finance by Chen Zhiwu, a deep dive. How does finance transform lives and the world? Have you ever wondered why some people make money work for them while others are trapped by it? Why did Western nations rise over centuries while China lagged in modern times? The Logic of Finance uses accessible language and profound insights to reveal how finance drives personal freedom and societal progress. Let's step into Chen Zhiwu's world to uncover the secrets of finance and unlock the code to wealth and freedom. 1. The essence and logic of finance. What is finance? It's not cold numbers or lofty jargon, but the exchange of value across time and space. Simply put, finance lets you borrow tomorrow's money today or move your wealth from Shanghai to London. This exchange's core lies in making resources flow, breaking the constraints of time, and connecting global possibilities. Take 17th century Holland as an example. The world's first stock exchange was born in Amsterdam. In 1602, the Dutch East India Company issued stocks, allowing ordinary citizens to invest in overseas trade. This not only raised massive funds for the company, but also let investors share profits. Chen Zhiwu writes in the book, "The essence of finance is turning future income into today's wealth." Through stocks, future trade profits were securitized, enabling ordinary people to participate in wealth creation. This cross-temporal resource allocation is the magic of finance. On a personal level, consider a young woman named Elena working in London with a monthly salary of £3,000. She saves £500 monthly to buy index funds, and after 30 years, compound interest could multiply her wealth several times. This logic of trading today's restraint for tomorrow's freedom is finance's core. Chen Zhiwu emphasizes that finance is not just a tool but a mindset, shifting people from passively accepting fate to actively planning their future. Finance's cross-spatial function is equally vital. For example, in the late 19th century, Chinese immigrants used CBC in Hong Kong to send money earned in Southeast Asia back to Fujian, supporting family homes or schools. This cross-regional flow of funds improved individual lives and drove community development. However, finance isn't without risks. In the 2008 financial crisis, the U.S. subprime mortgage collapse triggered a global market crash due to excessive leverage and complex derivatives detached from the real economy. Chen Zhiwu warns that finance's logic requires rational control, or it can turn from liberator to destroyer. Finance's core also hinges on trust. Whether it's stocks, bonds, or bank loans, contracts and credibility underpin them. In 16th century Italy, the Medici banking family fostered the Renaissance's artistic boom by building a credit network. Chen Zhiwu notes, without trust, finance is a castle in the air. Trust is not just finance's foundation, but its lifeblood. In medieval Europe, Italian bankers invented the bill of exchange, solving the problem of secure funds for long-distance trade. For instance, a 13th century Florentine merchant could pay for goods in Paris using a bill of exchange, avoiding the need to carry cash. This trust-based financial tool lowered transaction costs and fueled Europe's commercial prosperity. Chen Zhiwu highlights that each financial advancement comes with improved trust mechanisms. Take modern banks, their core function is to take deposits and issue loans, but this relies on depositors trusting the bank to safeguard their money. In the 2008 crisis, the collapse of Lehman Brothers in the U.S. sparked panic withdrawals, showing the consequences of broken trust. Chen Zhiwu notes that modern financial systems rebuild trust through deposit insurance and regulations. For example, the U.S. Federal Deposit Insurance Corporation FDIC guarantees up to $250,000 per depositor, encouraging people to trust banks and enabling capital circulation. In China, building trust faced greater challenges. Qing Dynasty money shops relied on family-based credit, lacking legal protections, so if a manager betrayed trust, customers had no recourse. In contrast, modern China's banking system, with central bank oversight and deposit insurance, has gradually earned public trust. For instance, in 2015, China introduced deposit insurance, securing deposits up to 500,000 yuan, boosting confidence and advancing financial markets. Trust is also reflected in financial market transparency. Take Carl from Sweden, who invests in global ETFs via a mobile app, relying on transparent exchange data and regulations. Chen Zhiwu points out that transparent markets allow ordinary people, not just elites, to participate in wealth distribution. This trust mechanism transformed finance from an elite game to a mass tool. This reminds us that finance's logic is not just about technology, but about human relationships. Finance drives historical progress. Finance is not only a personal tool, but a driver of national rise and fall. Historically, financial innovations often accompany the rise of great powers. In 17th century Holland, stock markets and bond financing built a global trade empire. Citizens bought Dutch East India Company stocks, sharing spice trade profits, while the state used bonds to fund naval expansion. Chen Zhiwu writes, Holland's rise wasn't due to plunder but because financial systems mobilized capital. The 18th century British case further proves this. In 1694, the Bank of England was established, issuing bonds to fund wars while allowing private banks to grow. This propelled Britain to lead the Industrial Revolution. In contrast, France at the time relied on high taxes and royal loans, lacking a market-based financial system, and fell into a fiscal crisis during the 1789 French Revolution. Chen Zhiwu writes, financial markets shifted nations from mere plunder to sustainable wealth creation. A vivid example is Britain's South Sea Company bubble. In 1720, exaggerated trade prospects drove the company's stock to soar before crashing, devastating investors. Yet, this crisis birthed modern financial regulation, maturing Britain's capital markets. Finance's trials and evolution laid the groundwork for national strength. Similarly, 19th century U.S. railroad construction, funded by bonds and stocks, connected the east and west coasts, underpinning industrialization. In 1869, the first transcontinental railroad was completed, backed by Wall Street capital. In contrast, China's financial development lagged for centuries. During the Ming and Qing dynasties, merchants' capital couldn't be marketized, relying instead on family loans or government intervention. For example, Ming merchants hoarded silver but, without stock markets, couldn't channel capital into large-scale production. This limited economic expansion and caused China to miss industrialization opportunities. Chen Zhiwu argues that finance's absence was not just a technical lag but a shackle of institutions and mindsets. Financial progress often goes hand in hand with technological breakthroughs. In 17th century Holland, alongside stock markets, printing technology spread financial information. Amsterdam newspapers published stock prices regularly, enabling investors to track market trends. This information revolution enhanced market transparency, drawing more citizens to invest. Chen Zhiwu writes, technology extended finance's reach to ordinary people. Another example is 18th century Britain's fusion of steam technology and finance. Early Industrial Revolution steam engine development required massive funds, and London's bond market provided factory owners with capital. For instance, James Watt's steam engine improvements were funded by banker Matthew Boulton. Boulton raised funds through bonds, advancing technology while letting investors share industrialization's profits. This synergy of technology and finance accelerated Britain's rise. In contrast, China's technological advances didn't integrate with finance. For example, the Song Dynasty's movable type printing boosted information spread, but without capital markets, merchants' funds couldn't fuel production. Chen Zhiwu notes that China's financial lag limited the commercialization of inventions, leaving many in the lab. This historical lesson underscores that finance and technology's integration is key to economic takeoff. Finance also promotes social equality. In 18th century Britain, stock markets let the middle class share in wealth distribution, not just aristocrats. The London Stock Exchange's growth allowed ordinary citizens to invest in textile mills or shipping firms, reaping Industrial Revolution benefits. This wealth diffusion broke traditional class barriers. Chen Zhiwu emphasizes finance channels wealth from a few to the broader masses, boosting social mobility. 3. China's financial challenges. Why was China's financial development so slow? Chen Zhiwu believes the answer lies in historical and cultural constraints. In the Qing Dynasty, Shaanxi money shops were China's financial peak, acting as ancient banks by linking national trade through remittances. For example, Lei Lutai's Rishinking money shop in the early 19th century used silver notes for cross-provincial fund transfers, solving merchants' cash transport issues. However, these shops relied heavily on family trust, lacking modern banks' transparency, and collapsed when families declined. A deeper reason lies in institutions. The Qing government tightly controlled finance, stifling capital market growth. For instance, in 1644, the Qing court banned private bond issuance, fearing loss of fiscal control. This pro-agriculture, anti-commerce policy stifled financial innovation. Chen Zhiwu laments, in ancient China, wealth was hoarded in families or cellars, not markets, missing capital's amplifying effect. Take Hu Zuyan, a Qing-era red-top merchant who amassed wealth through money shops and official TIs but went bankrupt in 1883 due to Empress Sixi's interference. His failure was not just personal but reflected finance's fragility without institutional support. In contrast, the West used limited liability companies and stock markets to spread risk, sparking widespread participation. In 19th-century London, citizens could buy railway bonds to share in growth, while Qing-era Chinese relied on family loans, concentrating risk and lowering efficiency. Modern China's financial struggles were also evident. In the early 20th century, Shanghai briefly became Asia's financial hub, with the Shanghai Stock Exchange thriving in the 1910s. However, wars and policy shifts halted this progress. Chen Zhiwu notes that China's financial modernization requires open markets and robust legal systems to unleash potential. In the early 20th century, China's financial system saw a brief dawn. After the 1911 Xinhai Revolution, Shanghai became the Far East's financial center, attracting foreign banks like CBC and Standard Chartered. By 1914, the Shanghai Stock Exchange's trading volume surpassed Hong Kong's, covering industries like rubber and textiles. For example, Chinese merchant Zhang Jian founded the Dashing Yarn Factory, using stock financing to build one of China's first modern textile firms. These market-driven efforts showed China's financial potential, but wars and political turmoil disrupted progress. Post-1907 civil wars and foreign invasions stalled Shanghai's financial markets. Chen Zhiwu analyzes that financial modernization needs stable politics and legal protections, which modern China lacked. For instance, the 1930s silver crisis, caused by government policy missteps, led to capital outflows and bank failures. Post-reform, China's financial markets revived. In the 1980s, the establishment of the Shenzhen and Shanghai stock exchanges marked a capital market restart. For example, on its opening day in 1990, the Shanghai Stock Exchange drew thousands of citizens queuing to buy stocks, sparking an investment boom. Chen Zhiwu believes this period saw China's finance align with global standards, though challenges like state-owned enterprise interference and incomplete regulations remain. Like Huawei in Shenzhen, its early growth relied on bank loans and government support, but capital market financing fueled its rapid expansion into a global tech giant. Chen Zhiwu notes that Huawei's success proves finance's role in innovation but reminds us that ordinary firms need fairer financing channels. He suggests China further open its bond market to lower financing costs for SMEs, enabling more innovative firms to benefit from finance. He cites Hong Kong's open financial policies in the late 20th century, which made it a global financial hub, proving the importance of institutions. Cultural attitudes also matter. Confucianism's emphasis on gentlemen valuing righteousness viewed profit-seeking skeptically, lowering merchant status and deeming finance a lesser trade. This mindset limited capital's large-scale operation. For example, Qing-era scholars criticized money shops as profit-driven, hindering their evolution into modern banks. Chen Zhiwu argues that a shift in mindset is essential for financial modernization. 4. Financial wisdom for personal wealth. Finance isn't just for nations but a tool for individuals to change their fate. Chen Zhiwu emphasizes that modern financial tools like insurance, funds, and bonds empower everyone to achieve wealth freedom through planning. Take insurance, it turns future uncertainty into manageable costs. Consider James, an American programmer earning $100,000 annually. He buys life insurance for $2,000 a year, ensuring his family's stability if he passes unexpectedly. This small cost for big protection logic is finance's gift of security. Investment is another key wisdom. Chen Zhiwu often cites Warren Buffett. In 1988, Buffett invested in Coca-Cola through Berkshire Hathaway at about $10 per share, which rose to over $50 after 30 years, yielding over 10% annualized returns. Buffett's value investing principle, choosing companies with steady cash flows for long-term holding, applies to ordinary people. Low-cost index funds diversify risk and share economic growth. Chen Zhiwu writes, investing isn't gambling but rational long-term planning. Compound interest is the core of financial wisdom. Take Elena again. If she invests $5,000 annually from age 25 at a 7% return, by 65, her wealth could exceed $500,000. This friend of time effect encourages early investing. Chen Zhiwu stresses, compound interest is finance's magic, but it demands patience and discipline. He suggests the 4-3-1 rule: 40% in stocks or funds, 30% in savings, 20% in insurance, and 10% in cash for balanced asset allocation. Yet, personal finance has pitfalls. In 2008, during China's stock market frenzy, many retail investors chased short-term gains and got trapped. For example, Ms. Zhang from Shanghai bought bank stocks at high prices in 2007, losing over half her investment in the 2008 crash. Chen Zhiwu warns that investing requires avoiding emotional decisions and sticking to rational analysis. He recommends low-cost index funds with regular contributions to reduce market volatility risks. Financial tools also include loans and credit cards. Reasonable borrowing can amplify personal capabilities. For instance, Caroline in Sweden took a mortgage to buy an apartment, renting it out to cover interest and earn extra income. Chen Zhiwu notes that loans borrow tomorrow's money for today's dreams but must be used cautiously to avoid over-leveraging. Other tools include REITs, real estate investment trusts, and annuity plans. These let ordinary people access professional wealth management. For example, Linda in Canada invests in REITs, indirectly owning commercial property shares and earning steady dividends. REITs securitize real estate profits, lowering investment barriers so people don't need to buy entire properties to benefit. Chen Zhiwu notes that such innovations enhance asset liquidity and promote equitable wealth distribution. Annuity plans are another practical tool. Take Mr. Chen in Singapore, who invests S1000 monthly in an annuity, receiving S3000 monthly after retiring at 60. This delayed gratification product helps address longevity risks. Chen Zhiwu stresses that with longer lifespans, traditional savings fall short, but annuities leverage compounding for long-term security. Financial derivatives also offer risk hedging. For example, Tom, a Chicago trader, uses options to lock in corn price fluctuations, stabilizing farm income. Chen Zhiwu cautions that derivatives are complex but, used wisely, manage risks effectively. He advises ordinary investors to access derivatives indirectly via funds to avoid losses from lack of expertise. China's financial tools have diversified recently. Products like Yubao, a money market fund, let people invest with low thresholds, earning higher returns than bank deposits. Chen Zhiwu sees this as a sign of China's maturing financial market but urges investors to stay risk-aware and avoid chasing high returns blindly. He cites the U.S. credit card debt crisis, driven by ignored repayment costs, as a reminder to use leverage rationally. Reflecting on cultural attitudes. Why are many Chinese skeptical of financial tools? Chen Zhiwu attributes this to Confucianism's deep influence. Confucianism promotes raising children to support old age, emphasizing family reliance over market-based security. For example, traditional Chinese families prefer saving or buying property over insurance or funds. This mindset faces modern challenges. Children's independence weakens family-based support. Take Zhang Hua, a Shanghai white-collar worker earning 20,000 yuan monthly. He saves most of his income in banks, fearing investment risks, but low interest rates mean his wealth shrinks against inflation. Chen Zhiwu notes that tools like annuities or bond funds offer better retirement security. He writes, finance shifts individuals from family dependence to independence, but it requires a mindset change. Confucianism also values contentment with simplicity, viewing wealth pursuit cautiously. This suppressed financial innovation. For example, Qing-era scholars criticized money shops as profit-driven, limiting their evolution into modern banks. Chen Zhiwu argues that modern society must redefine profit as a driver of value creation, not a moral burden. He contrasts this with Western individualistic financial views. U.S. middle-class families invest in 401k plans for retirement, not relying on children. This mindset fosters financial market growth and personal economic independence. For example, Mary in the U.S. invests $500 monthly in a 401k from age 30, accumulating nearly $1 million by 60. Chen Zhiwu calls for China to culturally embrace finance to unlock individual potential. Financial education is key to this shift. Developed nations show that financial literacy boosts wealth management. For instance, Australia introduced financial education in schools in 2008, teaching budgeting and investing basics. Young people educated this way prefer funds over savings, accumulating wealth faster. Chen Zhiwu writes, financial education turns people from slaves to masters of money. The U.S. 401k system relies on financial education. Companies offer workshops to help employees understand retirement investment options. For example, Sarah in Boston, guided by her company's financial courses, allocated 401k funds to stocks and bonds, amassing $800,000 in 20 years. Chen Zhiwu suggests China adopt this model, with businesses and schools promoting investment knowledge. China's financial education is emerging. Some Shanghai universities offer personal finance courses, teaching asset allocation and risk management. Chen Zhiwu recommends more government and corporate investment in online courses and community workshops to spread financial knowledge. He stresses that rural financial education is critical, as farmers often lack investment options and fall into high-interest loan traps. Mindset shifts also need educational support. Chen Zhiwu notes that Japan's 1982 financial education popularized investing, with families buying funds and insurance, boosting economic vitality. China's recent financial literacy efforts need further momentum. For example, schools could teach budgeting and fund investing to cultivate financial thinking from a young age. 6. The future of finance and society. Finance's logic isn't just about the past, it shapes the future. In today's globalized world, financial markets connect the globe at unprecedented speed. As the world's second-largest economy, China's financial role is increasingly vital. From opening the Shanghai and Shenzhen stock markets to internationalizing the yuan, China's financial reforms are accelerating. Chen Zhiwu envisions China's future needs more open financial markets to serve innovation and development. Take Hong Kong. Its open financial policies in the late 20th century attracted global capital, making it Asia's financial hub. During the 1997 Asian financial crisis, Hong Kong's strong reserves and regulations withstood the shock. This shows that open markets enhance economic resilience. Chen Zhiwu believes mainland China should follow Hong Kong's lead, easing capital market controls to spur innovation. Finance also drives sustainability. Green finance has become a global trend, supporting environmental projects through bonds and funds. For example, in 2020, the EU issued €17 billion in green bonds to fund renewable energy and low-carbon transport. Chen Zhiwu notes that finance not only creates wealth but directs resources toward societal good. Take Norway's pension fund, the world's largest sovereign wealth fund, managing over $1 trillion with 30% invested in green energy firms like wind and solar. This delivers returns while advancing global decarbonization. Chen Zhiwu sees huge potential in China's green finance market. In 2021, China issued over 500 billion yuan in green bonds, funding high-speed rail and clean energy. For individuals, green finance offers participation. For example, Miss Lin in Guangzhou invests in green funds supporting solar firms, earning returns while contributing to environmental goals. Chen Zhiwu emphasizes that green finance lets ordinary people drive social change, reflecting finance's universal value. For individuals, finance is a bridge to freedom. Whether building wealth through investing or mitigating risks with insurance, financial tools empower people to control their destiny. Take Jack Ma. Through Alibaba's IPO, he leveraged capital markets to rise from a teacher to a global entrepreneur. Ordinary people may not replicate Ma's success, but financial knowledge lets them plan their future. For example, Mr. Wang in Beijing saves 10,000 yuan annually in a corporate annuity, expecting 5,000 yuan monthly pensions in retirement. Finance's future is tied to technology. The rise of blockchain and digital currencies is reshaping finance. For instance, Bitcoin surged from cents in 2009 to $60,000 in 2021, showing decentralized finance's potential. Chen Zhiwu cautions that while innovative, digital currencies carry speculative risks. He advises focusing on stable investments while staying attuned to tech trends. Epilogue: Embracing financial wisdom. The logic of finance is a bridge connecting past and future, individuals and society. It shows that wealth isn't just money piled up but a tool for creating value. From Holland's stock markets to Buffett's value investing, from Qing money shops to modern index funds, finance has transformed the world and individual lives. Chen Zhiwu's insights remind us that finance is not just technology but a mindset. It shifts us from passively accepting fate to actively shaping our lives. Whether saving for your child's education or planning retirement, finance offers possibilities. Let's embrace the logic of finance to open a new chapter of wealth and freedom.